Hi, and welcome to this week's market presentation. Latest news. Starting with the latest developments regarding the war in Ukraine, peace talks to end the war continue. U.S. brokered talks in Geneva reportedly reached a quote critical moment, with Ukraine engaging on a revised peace framework under a Trump-set deadline. For the moment, the impact of the recent developments on markets has remained limited, as there's still significant unmet expectations regarding a rapid end to the war and subsequently an end to the ongoing sanctions regime against Russia. Depending on the progress of future talks and the closer that a peace resolution appears to be in sight, the more bearish markets could get, particularly if there are signals that sanctions against Russian energy exports will be taken away sooner rather than later. On to the situation in Venezuela. Tensions between the United States and Venezuela continue to increase. Over the past week, President Trump declared Venezuelan airspace above and surrounding the country to be considered closed, and then quickly backtracked the following day. Nonetheless, we are seeing increased military activity near the coast of Venezuela by the U.S. Navy, and the prospect of military strikes inside the country appear to be increasing as well. So far, the reaction from energy markets in particular remains limited, given the lack of a negative impact on the physical flow of oil exports out of the country. Nonetheless, Venezuela's oil exports, which amount to roughly 600,000 barrels per day, could see them having a bigger impact on pricing if they were to be negatively impacted. A developing situation we will continue to keep tracking. Weather. Looking at the latest weather forecast, we note an increasing temperatures across most of Europe expected within the middle and end of this week, following a pretty cold period over the past week. Temperatures are expected to increase further as we move towards the beginning of the following week. Precipitation is also expected to pick up throughout the course of this week, particularly amongst Western and Northern Europe. Wind speeds, which had been slightly lower over the previous week, are similarly expected to increase, particularly near the North Sea. Macroeconomics. New PMI figures for the month of November were released for several economies we are tracking. Most notably, the Euro area manufacturing PMI for November came in at 49.6, just slightly below the previous value of 50 in the month of October, and showing a still resilient manufacturing sector in Europe. Over in China, we see largely unchanged manufacturing sector PMIs at 49.2. And overall, we see the biggest reduction in PMIs coming from India, which saw a decrease from 59.2 to 56.6. On the service side of things, we have seen November 25 figures for the service sector in China, which saw a slight contraction from 50.1 to 49.5. Crude oil and LPG. Crude oil markets saw a relatively stable price evolution in the shorter term over the past week, with a more pronounced movement when it came to 2026 on the Brent side of things, with a just over 8% decrease week over week. Overall, crude oil prices continue to face bearish pressure from the expectations of an oversupplied market throughout 2026. Although now, as we near the beginning of the year, we're seeing less movement until we get more concrete figures indicating just by how much will the market be oversupplied. On the bullish side of things, limiting further decreases in the market are certainly the heightened geopolitical tensions in Venezuela, as well as the confirmation from OPEC Plus that it will be pausing its production quota increases throughout the first quarter of 2026. Lastly, as we look forward to the Federal Reserve's meeting in December, The expectations of an interest rate cut have increased over the past week, with now a cut probability having increased to 88%, which could be adding some demand expectation increases as a result. However, on the better side of things, as we mentioned, the expectations of an oversupplied market continue to weigh on prices. The latest monthly report from the Energy Information Agency out of the US shows a relatively unchanged forecast month over month, with limited changes to both supply and demand, continue to indicate an oversupplied market. Natural gas. Looking at natural gas prices, we've seen a bearish price evolution, not just over the past week, but over the last 4 weeks as well, with pricing decreasing pretty steadily, both in the short term and further along the curve. Looking at the storage levels of natural gas across Europe, we see they have decreased further, now moving to 676%, noticeably below the past 12-year average and below last year's levels. Nonetheless, the slightly warmer weather forecast over the next week in particular is easing some of the pressure that the lower storage levels are having on the market. Looking at the level of injections and withdrawals, we note the very sharp increase in net withdrawals over the previous week, driven by that much colder weather we were having across Europe. And now over the last few days, we are seeing that increase once again on the back of that warmer weather. But nonetheless, withdrawals over the last 7 days have remained near the lowest levels in over 12 years. Looking at total supply and demand, we note that very sharp uptick in total demand, pushing total demand of natural gas above the past 5-year average. On the supply side of things, while supply has remained higher than last year, even if just slightly, particularly over the past 7 days, we are still seeing that structural decrease in total supply compared to previous years. Looking at the supply mix, we note the relatively stable evolution of Norwegian gas flows to Europe, just below last year's levels and just below the past 5-year average as well. Looking at LNG sendouts there, we still note the near record high levels of LNG sendouts as part of the European supply mix. And we also see the very quick response to demand signals, with the decrease in total demand as a result of improving weather conditions, seeing a quick reduction in LNG sendouts. The outlook for LNG imports into Europe remains optimistic, particularly given the weaker demand out of Asia, especially from China, as they continue to purchase sanctioned Russian gas from the Arctic 2 LNG terminal. And we also note the record high levels of US LNG exports, which reached a record high in November at 15.17 billion cubic meters. Sentiment amongst investment funds continues to remain bearish, with the level of net positions moving towards net short positions for the first time since early 2024, as the weather outlook and supply outlook are adding more bearish sentiment to the market than bullish ones. Coal. Looking at coal prices saw limited movement over the past week. Looking at the API2 index moving just under 2% week over week. The API4 index up around 1.3% over the past week. Overall, we are seeing more limited movement when it comes to global coal prices. Part of the reason being that we are seeing price levels remaining just above many producers' profitability threshold, and so we do see much less limited room for further downward movement. Overall, on the bearish side of things, in Europe in particular, we're seeing the lower gas prices and elevated carbon allowance prices limit coal-fired power generation. Additionally, the ample coal stocks at ARA terminals currently, given current demand levels, have been limiting further import demand. And then the mild weather forecasted in the shorter term as well, limiting some future demand expectations for coal in Europe as well. Over in Asia, we do see in India, coal-derived power generation registering its steepest year-over-year contraction since 2020, in large part due to strong hydropower output. Additionally, Chinese spare production capacity could certainly offset a spike in demand in the country, further limiting the upward pressure on the market. Nonetheless, we are seeing steady Asian weather-driven demand, particularly across China, Taiwan, and South Korea. And then we've also noticed the Indonesian supply recently being constrained due to adverse weather conditions. EU and UK emission allowances. Moving on to carbon allowances, here we see that continued bullish price evolution in both the European and UK markets. On the European side of things, the spot price increased by 2.3% on the week, with the December 25 product up 3.5% week over week. Overall, the expectations for a tighter European ETS market starting in 2026, it's certainly increasing that upward pressure on the market, with the auction break starting on December 16th and then back again on January 7th. The recent cold spell and lower wind power generation certainly supported some residual load and gas to power generation, particularly over the past week, adding to the increase in power sector emissions on the European side of things, as we can see here, pushing overall emissions closer to the past 5-year average. Although nonetheless, overall power sector emissions so far this year remained lower year over year. Looking at the level of investment fund positions here, we note that European allowances net long positions now above 100 million tons, and we've also seen the number of participants reaching a new record of 502. Now, the options expiry date is on the 10th, with the final December settlement date on the 15th, and so we could see some additional activity as we near that deadline. On the UK side of things, the level of net long positions remains near record highs, very much on the back of the continuing negotiations regarding the linkage of the EU and UK ETS markets. Electricity. Looking at electricity price. Further along the curve, we've actually seen a Looking at total demand and residual load, we know that sharp increase in total grid demand as a response to the colder weather, pushing total demand to the highest levels over the past 5 years. On the other hand, residual load, while increasing as well over the past week, has remained more closely in line with the past 5-year average. Nuclear generation continues to be a bright spot amongst the European power mix, with French nuclear power generation remaining near the highest levels over the past 5 years, although we did see a slight decline over the past week. Nonetheless, the outlook remains positive for French nuclear power output, and as a result for European power output as well. Looking at renewable energy output, we do note the weaker wind power generation surge compared to a few weeks ago, where we're looking at record high levels. Nonetheless, the forecast of stronger wind speeds over the coming week could see a further boost to wind power generation. Looking at hydroelectric generation, we've also seen here a nice uptick over the past week, pushing output to the highest levels over the past 5 years. And then solar continues the seasonal decline as we get deeper into the winter. Fossil fuel power generation has seen a nice uptick over the past week, very much driven by the increase in total demand and the lack of a corresponding increase in renewables. Overall, fossil gas power generation has filled the majority of that gap, pushing output significantly higher than the same time last year and above the past 5-year average. Coal-fired power generation has similarly seen an uptick over the past week, but given the higher emission allowance prices and the lower gas prices, we've seen a less upward pressure on coal demand from the power sector. Overall, we note here how renewable power generation has remained a little more steady over the past week, remaining below the high that was seen last year, while fossil fuel power generation has seen a more steady increase in the face of the increase in total demand. Lastly, looking at guarantees of origin, we note the decrease price movement over the past week, particularly in the shorter term for 2025 production years. Overall, in absolute terms, the price movements week over week remain quite limited, and overall price levels remain near the lowest levels we've seen over the last couple of years, largely on the back of that improved supply outlook moving forward. That covers this week's market presentation. Thank you for joining.